Complete theory of exchange rate determination in the short run and in the long run. The asset approach tells us what is the exchange rate today. Right? What is the asset approach? Well, we have here basically the equilibrium in the domestic money market, the US money market. And we know the prices are fixed in the short run. And so basically money supply or GDP will affect the interest rate. Then we have the same condition for the European market. The prices in Europe are also constant because it's the short run. And so basically money supply and GDP will determine the interest rates. Conditional on expectations about the future, interest rates will determine today's exchange rate. So that's what we've seen so far today. In the short run, money supply in the two countries determines the interest rate. The interest rate determines today's exchange rate. But we sort of took as given is the expectation of the exchange rates. Okay? Now the question is, where do these expectations come from? What we're going to think that expectations are determined upon is the long-run model of exchange rate determination. How are you going to know what's going to happen to the exchange rate of the dollar 10 years from now? It's going to depend on the price level of the US and Europe 10 years from now. Because in the long run, the prices will adjust and they will determine the exchange rate. Okay? So how do we determine the expectations? Well, we determine them with the monetary approach, the long run, where prices adjust. Now, in the long run, basically, there's a typo, there shouldn't be an E here, obviously, right? In the long run, you can think of the long run as a situation in which the expected exchange rate equals today's exchange rate. You know, we're in the long run when our expectations are exactly equal to what's going on today. If we expect something to happen that's different from today, it means that we're not in the long run. Things are going to change, or we expect them to change. So basically, in the long run, the two interest rates of the two countries are the same, because today's exchange rate equals the expected exchange rate. In any case, that means that basically the money supply of the two countries in the long run will not really determine the interest rate because that's the same everywhere, but they will determine the price level. And the relative price level, we know from the monetary approach, will determine the relative exchange rate. Okay? Notice here that everything is with the E subscript, superscript, because it's all about expectations. And so, you know, our expected money supply, our expected GDP, et cetera, et cetera. So today we're going to make some, you know, restrictions on these expectations. We're not going to build a model to predict out GDP, et cetera. Okay? We are basically going to think that a lot of things are not going to change. The only thing that changes is like the money supply today. Okay? So to summarize, here's what we have in, you know, perhaps with a nicer representation. We're going to start from a long-run equilibrium, where the exchange rate today is exactly what people expect it to be. And then we're going to shock the system. We're going to make the money supply change, or the GDP change, or the L bar change. Okay? What's going to happen to today's exchange rate? Well, that's going to be determined by the asset approach, where money supply, real income in both countries determine, you know, this is for Zoom people, this is the green panels on the top, determine on the red boxes the nominal interest rate in the two countries, and the two interest rates will determine the exchange rate. But then people are going to make new expectations. If the money supply today changes to a permanently higher level, you're going to expect a different exchange rate in the future. How are you going to expect that? Using the monetary model. Or maybe the money supply changes, today, that's gonna affect the exchange rate today. But that's also gonna affect our future expectations of the exchange rate. As the money supply, for instance, increases, that means that the price levels perhaps will also increase. So that's gonna cause a certain expected exchange rate. Okay? So there's a lot of dots here. So just follow, okay? So we're gonna look at the case in which the money supply in the US increases. So first thing first, let's look at the left panel. This is exactly what we saw before. We saw an expansion in the monetary policy, in the money supply, in the real money balances. I don't know if you can see it here, but M of the US goes from a 1 level to a level 2, M US number 2. So money supply shifts to the right. That means that today's interest rate declines. Exactly what we saw before. So we go from 0.1 to 0.2. Forget about the FR2 for the moment. Forget about the red line. Okay. The interest rate declines. The dollar return on dollar deposit declines from I US 1 to I US 2. That means that our domestic return curve shifts downward. The FR, the foreign return curve, does not move. And so we go from 0.1 prime to 0.3 prime. Okay? This is exactly what we saw before. There's an expansion in monetary policy in the US. Interest rate declines. That means that people don't want to buy dollars. They want to buy euros because they have a higher interest rate. And therefore the dollar depreciates. Okay? This is what we saw before. Are we all on board? Sound good? Okay, now let's think about the expectations. What do we expect is going to happen to the dollar given a permanently higher money supply? So in the future, we expect the dollar to depreciate. So our expectations are going to change. There you go. Our expectation, our E expected, is going to change. How do we expect that to be? We expect that to be higher because we expect the dollar to depreciate. So we expect the foreign expected return to be higher. Okay? So regardless of whatever is today's level of exchange rate, since we expect the dollar to depreciate in the long run, because we have higher money supply, we expect the dollar to depreciate. So we're going to make a higher return, higher expected return, if we put money on European bonds. So what's going to happen is that the FR curve is also going to move to the right because we expect the dollar to depreciate in the long run. Okay? So since you expect a further depreciation of the dollar, the foreign expected returns are higher, so you buy even more euros, so you cause an even larger depreciation of the dollar. Okay? So in a sense, we're going to see in a second, the dollar overshoots. So we're going to have a higher level of depreciation than perhaps is going to happen in the long run. We're going to see in a second. Okay? But does this make sense? So the increase in the money supply, interest rate goes down. You buy less dollars, more euros. The dollar depreciates. On top of that, you update your expectations about the future. You expect the dollar in the long run to depreciate because of the monetary model. Therefore, the expected return that you make on euro deposit is even higher than before. And so you buy even more euros, causing a pronounced depreciation of the dollar. It is more pronounced than what the simple asset approach would predict. Okay? Make sense? Yeah, good. You like this? It's getting even more exciting. Because now this is what the part that you don't expect, I guess. I mean, I hope, unless, I don't know. If you expected this, go do some finance, okay? but perhaps something that you weren't expecting when you sat down today. So what's going to happen in the long run? Now we're in the short run. That's what happens to the exchange rate. The dollar depreciates. Beautiful. What's going to happen in the long run? Well, we said the prices will adjust, right? What's going to happen to the prices? Exactly. Or was that an up, or you were just stretching your fingers? Okay, yeah, let's think about it. So what's going to happen to prices in the US in the long run? You know that the money supply increased. Where are the prices in this figure? They're here in the real money balances. Right? So if the prices, look at the figure for a moment. If the prices go up, right, the prices are at the denominator. If the price increases from P bar 1 to some higher level, that means that this whole thing becomes smaller. So that these real money balances will shift to the left. As it shifts to the left, the interest rate will increase. So the domestic return will increase. So we're going to move along this FR2 curve. And the interest rate increases. What's happening to the exchange rate? It's going down, right? So what's happening to the dollar? It appreciates. Oh, wait a second. So the dollar depreciates in the short run, but appreciates as we move to the long run. What is going on, Luca? Well, this is the surprising part, I hope. Right? The surprising part is that because we're overshooting, because we're depreciating too much, quote unquote, the dollar goes to its long run equilibrium via an appreciation. Okay? So let's see again in this figure. Okay? What's going to happen is that the price level in the US is going to increase. Why is it going to increase? Because there is more money in circulation. You know, US people have more money, so they're going to buy more coffee. The beginning, nothing's going to happen because Starbucks does not adjust prices every day, right? But then they see higher demand. Perhaps they hit some capacity constraints, especially perhaps not all firms, perhaps some firms only. Prices will increase little by little. As prices in the US increase little by little, there's gonna be a shift to the right of the money supply, of the real money supply balances. So the vertical curve MS2 is gonna shift to the left. You know, it's as if an increase in prices is de facto a restriction on monetary policy. So since the real amount of money declines, the interest rate will increase little by little. Okay? The more prices adjust, the more the interest rate goes back up. Okay? We're going to see why it goes exactly back up at the initial level. But you should sort of figure out, right? We said that the long run is when the expected exchange rate equals today's exchange rate. And so in the long run, the dollar return on dollar deposit equals the euro return on euro deposit, because there's no expectations of depreciation of anything. So that's why in the long run, we go back exactly to the beginning. Another way to see this is that monetary policy is only affecting the short run, not in the long run. In the long run, we go back to the initial level, but prices are higher. That doesn't mean that you should not have monetary policy, because in the short run, it has huge effects. And you know, the short run is important because the long run is a combination of short runs. In the long run, we're all dead, blah, 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 okay? So don't think of this as we shouldn't have monetary policy, because that's a debate that they had 40 years ago, and we all agree that monetary policy is important. But in any case, I hope it's clear that in the long run, prices increase, money supply, real money supply shifts to the left, and that's going to increase the domestic interest rate. Since there is an increase in the domestic interest rate, more and more people are going to buy dollars to get the higher and higher dollar returns. By buying more and more dollars, they're causing the dollar to appreciate. So what's happening on the Forex market, panel D, we go from 0.2 prime to 0.4 prime. Why? Well, because we have a steady increase in the interest rate on dollar deposit. So more and more people buy dollars, so the dollar appreciates. We're moving along this new FR2, okay? Now, as the exchange rate gone back to its initial level, let's look at the figure, right? We start at 0.1 prime, with a certain level of the exchange rate. We arrive at a 0.4 prime with a different level of the exchange rate. So despite the interest rate is back to its initial level, the exchange rate is not. The dollar has permanently depreciated.